Ladies and gentlemen, investors in the property market massively on the decline. Let's talk about the trend, where it's heading in the future. Stay tuned.
Good morning, everyone. Welcome to Morning Minutes. Myself, Michael Burgio, Mark Novak, episode 405. Where have all the investors gone? With huge capital growth, a surging property market, it's always good to look at who's buying. So vendors, so we can advise vendors, so we can target the marketing. And Mark, as you can see the graph behind me, it's painting a picture of a lot of owner-occupiers. What do you read of this? And it's not just over the last quarter, it's the last 5 years.
So it's pretty interesting that right now you can buy a property and it's positively geared. And for anyone that doesn't know what that means, it'll put money into your back pocket from day one. So after you pay the rent, the strata, the council, or whatever your outgoings are, you'll still be up. Now, you would think that would have skyrocketed the investor market, but quite the opposite, dude.
Yeah, it has, like, lowest interest rates ever. But I think we're the biggest, probably when we're looking at this graph, like, to give you a concept, but I'll bring it up on a bigger one. Like, from 2017, we're at about 40% of purchasers were investors. The heights was at 2015. At 45%, and we're probably just under 24%. And it's been a steady decline from 2017, which was probably our last peak, Mark, our big peak in the residential market. And the thing I'm looking into that was if you look at what's changed, because interest rates have gotten lower, it would probably be lending. For how investors were treated is probably one of the strongest reasons, I think, for this decline, because I don't think it's a sentiment of people going, I don't want property or one's enough sort of thing. I think it's you know as well, the serviceability became very hard for investors and how they looked at it, because the biggest change was previously when giving a loan, if you're buying an investment property, they would a lot of the time just look at it going, okay, the income of the property is $500 a week, your loan's $500 a week, it pays for itself, you're okay on your $60K annual income, and you've already got a property you live in. But I think the biggest change was they now want you to be able to show you can pay the property you live in mortgage and the full mortgage of the investment property, and some banks will take no income into consideration. So basically, your income needed to be, say, 120 grand rather than 60 for the same loan and transaction. What do you think? That's probably, my thought.
People have got to fundamentally remember that, traditionally over the last 10 or 20 years, it didn't matter if you had a very good income or if you had a very good asset position. Either or, you could actually get a loan. Now that fundamentally changed with all the Royal Commission and the couple of years of going into the Royal Commission and the couple of years of coming out of the Royal Commission, where responsible lending was treated a lot more seriously, and they turned around and said, look, we don't care if you own that property outright. If you have $1 million property with no debt, we really don't give a shit. We want to know that if we do give you a loan, that you can actually fundamentally service it with your incomes with rent or incomes through your work. We actually don't care if you've got $1 million that we can secure in the event of you defaulting. I think that really swung that investor market heavily.
It did, didn't it? Like, Mark, I remember when we were doing Osprey, we had a client with $4 million worth of assets of properties, all paid off, and they struggled to get a loan for a $500,000 studio because the broker was like, you have no income. And they're like, we have 3 properties paid off plus our home. We have 150K income. Like, yeah, but that's not your personal income. If all tenants stop paying rent, How will you pay for this property? They really scrutinized the income generating. And where do you think that will go? Do you reckon that's alarm bells for government, our economy, investors dropping off? Or do you think that's healthy? Or because are people just not going to invest, or they're going to buy something else? Stock, shares, business?
Well, but don't forget, this is some of this. It could actually really skyrocket rents by not having investors entering the marketplace. So, do you know what I mean? Like, people got to be really, really careful, because we want to encourage investors in the marketplace, because there are simply people out there that don't want to be. They don't want to be. Sorry.
They don't want to own. They want to rent.
This weather out there is torrential.
No.
So I think fundamentally people got to be really careful that, we want investors, we want that balance in the marketplace. I think it's good lending wise, and also I think through COVID it was discretionary. You could turn off buying an investment property very, very easily if you were an investor over the last 12 months. But if you're a young family of 4 living in a 2-bedroom unit, and you're both now working from home, that was a bit of a pressure cooker, which you really had to buy. So I think we can't forget that just investor spend is a lot more discretionary than owner occupier spend.
Yeah, and just like Luke said, investors went into hibernation during COVID, and they did, especially the commercial market. We felt it very, very hard. But even as Luke says, over COVID, it's a rapid drop from, even if we go back to 2017, 30%, 18, 30%. So even then, it's a 7% drop from investors. So it's going to be very interesting to see what happens, especially now when, like Mark, with that, I keep referring to Arthur Street sale, basically an original home we sold for $2 million. And 36, which 12 months ago, that would have been 9 months ago, would have been 1.4. And you look at that, what that would rent for, it was about 1.5%. So if investors do come back in the market, especially in the housing market, the growth has been so significant. Like, if you're an investor looking in 18, 19 compared to now, you're going to be, I think we're going to hopefully see a surge in different asset classes, offices, commercial factories, people trying to maybe do their own developments because of the capital growth there, which will stimulate construction. Luke's asked, what are open homes going to be like today? Whenever the weather's really crap, we find basically the serious buyers come out. Hey, Mark, like, if you normally have 10, you'll have 4 buyers, but they're the ones cashed up, ready to go, who are motivated to go through this weather. So some days even though it feels like the worst day, it's almost the best day to be working. It's like a Sunday.
Yes.
When we do Sunday open.
Yeah. It certainly knocks the people around that are sort of half-assed about it. But guys, I really want you to have a big think about this. And this is a live show, so if you've got any questions relating to investors that we're talking about today, where have investors gone the market, throw them at us. We're happy to have a chat with you about it live. I just think it's really, really interesting that something that people can't forget either is the government has built a lot of equity into the market. So I think one of the first things when you saw America have a really hard time, there was actually no fat or equity built into property. So where the loan was to where the worth of the value was pretty much the same place. So if they ever sold you up in America, there wasn't much fat there to save you or the bank. I think people shouldn't forget that part of our regulatory lending that we've had in the last 12 months, 36 months and 48 months, that there was actually a lot of equity being built in. So bank valuers were valuing stuff much harder, which could automatically add another 10% into it. So sometimes the bank valuers are often valuing it 10% lower, and then that actually gave equity not to the person who owned it, or did, I guess, have equity to the person that owned it, but had like a back end equity with banks. So I think that, and then now you can see that property market surging as well. There's equity built in there again. So you may find that people's appetite for investment property may grow because they've got some nice equity there to work with. but
Yes.
it's got to be matched and coupled by income, which will be the interesting one to see.
Yeah, exactly. And I think, as Luke says, yields are terrible in Sydney. I think it's just there's still some great yields for apartments, especially brand new apartments off the plan, existing at 1 or 2 better. I know in DY, when we compare about some of the house pricing, 1% yield, but apartments, you can still get 3-4%. And if you're borrowing at 1.5 or 1.8, there's still good money there. But I think the more and more I've been going through this with clients a lot at the moment, do you want equity, like capital growth, or do you want rental return? Because a lot of the traditional mindset is buy a house, stay away from strata. But when you look at with house pricing surging, then land tax is going to surge, and your yields are much lower. Like I mentioned it the other day, where a client was thinking about selling a property that generates for 4 mil, 100K income, and they could recreate that income with 3 granny flats on their houses and still have all the money in the bank. So I think investors just got to get a little bit more savvy, and be a bit more pinpoint on what they're looking to buy. The yields are there.
Their land tax bill is not going to change. But something that everyone should be really, really careful about is, I know this property market is not a sprint. Yes, it's sprinting, but it's a marathon. So when this boom goes, when the bust comes, when the boom comes, when the bust goes, when the whatever you call it, it's a marathon on a market. Now, I know Luke's referred to the city market. The yields are not that high, but the capital growth is absolutely phenomenal, and it always has been. And I'm talking a marathon, so it's easy to take 1 year or the last 3 years or pick a suburb. But if you pick any, majority of suburbs of Sydney, and I'm talking 95%, and if you pick those suburbs over 50 years, you are making 10% a year on your capital growth, and you are making 5% a year on the yield. Now that yield's going down to 4%, but the capital growth's certainly moving up. So I'd encourage investors to get into the market now. I don't think the market's overcooked, like the media is presenting. It's fact that the property market hasn't doubled over 10 years yet, and it will. And until it gets to that point, I don't think it's frightening. And even when it gets probably 30, 40, or 50% past that point, I don't think it's frightening over. So there's plenty of leg room in this real estate market for investors still.
Definitely. And Mark, I just want to bring up the podcast. We just cracked over 10,000 downloads as well. I just want to bring that up. So just want to thank everyone for watching and listening.
Yeah, thank you.
So where is
Look at that.
Look at that. Especially in the last 3 months, we've had 30, like of the 11,000, we've had probably 30% of that in the last sort of 90 days, which thank you, everyone. Obviously, originally it was more the video, but I remember we wanted to do podcasts. I remember something Tom Panos said was like, put your content everywhere and anywhere, because you don't know how people will absorb it. I think selling a property is the same. Yes, traditionally you don't realestate.com, but letterbox drops, signboards, Facebook, like you just got to put everything everywhere and let people. So I just want to, really happy with that.
Everyone, thank you so much for your support. Like it's been, and you know what, there wouldn't be a time that we meet people around in the street, out west, up north, down south, wherever, that actually know our agency through digital and support and have supported us that way. I was even at a funeral yesterday, and a gentleman from out west that I hadn't seen for 35 years was like, "Oh, I see your stuff." You're thinking, "Wow, that's unbelievable support," and thank you. And also, Michael, another thing there is, which I've always thought about, it goes across 15 channels. So podcast is one channel of 15 channels. It's going across 7 Facebook channels at the moment while we're talking. It's going out to another 7 Instagram channels after we talk. It's going out to another 3 LinkedIn channels. So it's a lot of fun. It's a lot of work. And thank you, everyone. And I hope we're educating people. And I love to know the topics that you want to know that we can help you with, because often it's sitting up here and it just stays up here. And if you can tell us what you'd like to know out of the show, we'd love to help you.
Yeah, definitely send us a private message, text us, email us, whatever topics you want, and we definitely appreciate it, because I love creating content, the educational content, rather than a lot of agents always just post, how good am I sold this, and it's like, who doesn't love talking about what they do and what they're interested in? So we enjoy the opportunity, and we thank everyone for watching.
And before we close out, good luck to everyone with these storms today and over the weekend. Good on you for the police, the fire, and the SES. And thank you so much for all of your support. You guys are absolutely selfless people, and thank you. And it's going to be a tough time for a lot of people in Sydney and New South Wales. So good luck.
Yes, thank you, everyone. Cheers. Bye.